you are deciding whether to click away or keep listening, the largest wealth transfer in human history is already underway, and 99% of humanity has absolutely no idea where that wealth is going. Today is Saturday, January 18th, 2026, and I'm about to prove to you that $45 trillion is shifting from one generation to another, from baby boomers to Gen X and millennials, and the people who understand where to position that wealth will become generationally rich, while everyone else watches their inheritance evaporate through inflation, taxation, and the systematic destruction of paper assets. This is not about stocks. This is not about real estate. This is not about cryptocurrency. This is about the oldest wealth preservation strategy in human history, and the evidence that this shift is accelerating is everywhere once you know how to read the data. Let me show you exactly what is happening, why the next 24 months will determine whether you capture this wealth or lose it, and why silver at $89.22 per ounce as of yesterday morning is not the top of the market, but the bottom of the greatest repricing event of our lifetimes. Let me start with the numbers, because they are so large that your brain will struggle to comprehend them. According to the most recent data from Cerulli Associates published in December 2025, approximately $124 trillion will transfer from baby boomers in the silent generation to younger generations by 2048. Read that number again. $124 trillion. That is more than 5 times the current GDP of the United States. That is more wealth changing hands in 22 years than has been accumulated in the entire previous century. But here is what makes this urgent right now, today, in January 2026. The transfer is not evenly distributed over 22 years. It is front-loaded. According to Macromonitor, the largest survey of U.S. financial service behavior, households with individuals aged 70 and over are projected to transfer $45 trillion to the next generation over the next decade. Not 22 years, 10 years. That is $4.5 trillion per year on average. That is $375 billion per month. That is $12.3 billion every single day. And here's the part that should terrify you if you are inheriting this wealth. That $45 trillion is calculated in today's dollars, assuming stable purchasing power. But the dollar is not stable. The dollar is dying. And if you inherit your share of that $45 trillion and leave it in dollars and bonds, in traditional financial assets, you will watch it evaporate before your eyes. Let me show you why. The national debt of the United States crossed $38 trillion on January 1st, 2026, just 18 days ago. The annual interest payment on that debt is now $1.21 trillion. That is more than the United States spends on defense. The government is borrowing money just to pay the interest on money it borrowed last year. This is the mathematical definition of a debt spiral. And there are only 2 ways out of a debt spiral. Default, which destroys the currency instantly, or inflate, which destroys the currency slowly. The government will choose inflation every single time. They will print money, they will devalue the dollar, they will make your $45 trillion inheritance worth less and less in real purchasing power until it buys a fraction of what it should. And this is not speculation. This is happening right now. The Federal Reserve injected $51 billion into the banking system between December 26 and December 28, 2025, through emergency repo operations. They printed $51 billion in 72 hours to prevent banks from failing on their silver short positions, when silver spiked to $84. Every time the Fed prints money to save the financial system, they dilute the value of every dollar in existence. And if they are printing $51 billion in 3 days, what do you think they will print over the next 10 years as they try to manage the $38 trillion debt? They will print trillions, and every trillion they print makes your inheritance worth less. Now, let me show you where the smart money is moving, because the $45 trillion wealth transfer is not being left in dollars. The people inheriting this wealth, the Gen X investors receiving $1.4 trillion per year over the next decade, the millennials projected to receive $45.6 trillion over the next 25 years. They are not keeping it in savings accounts earning 5% while inflation runs at 8 to 12%. They are moving it into hard assets, real estate, gold, silver, land, commodities, assets that cannot be printed, assets that hold value when currencies collapse. And the evidence of this shift is showing up in the pricing of those assets. Real estate values among high net worth households increased 29.4% since 2020, according to Coldwell Banker Global Luxury's 2026 trend report published on January 16th, just 2 days ago. Gold hit an all-time high of $4,647 per ounce on January 13th, up approximately 65% in 2025 alone. And silver, the most undervalued hard asset on the planet, gained 150% in 2025, rising from $30 per ounce in January 2025. to $91.78 on January 14th, 2026, and is currently trading at $89.22 as of Friday, January 17. This is not a bubble. This is repricing. This is the market recognizing that paper assets are worthless and hard assets are the only store of value that survives currency debasement. But here is where it gets interesting. Because while gold and real estate are moving higher, silver is the asset that offers the greatest upside for the smallest capital outlay. Let me explain the math. If you are a millennial or Gen X investor inheriting a portion of that $45 trillion, you have choices. You can put that money into real estate. But the average luxury property in the United States now costs over $2 million, according to Coldwell Banker. That is a high barrier to entry. You can buy gold. Gold is currently at $4,647 per ounce. If you inherit $50,000, you can buy approximately 10.7 ounces of gold. But silver is $89.22. For that same $50,000, you can buy 560 ounces of silver. And here is why that matters. The gold to silver ratio, the price of gold divided by the price of silver, currently sits at approximately 52 to 1. That means it takes 52 ounces of silver to equal the value of 1 ounce of gold. But historically, going back 2,000 years, the average gold to silver ratio has been between 10 to 1 and 15 to 1. Even in modern times, during the 1980 precious metals rally, the ratio compressed to 17 to 1. During the 2011 rally, it hit 31 to 1. Right now, at 52 to 1, silver is historically cheap relative to gold. If the ratio reverts to even 30 to 1, which is conservative by historical standards, silver would have to rise to $154.90 per ounce just to match gold's current price. That is a 73% gain from current levels. If the ratio goes to 20 to 1, silver hits $232.35. That is a 160% gain. And if the ratio reverts all the way to the historical average of 15 to 1, silver would be $309.80 per ounce, a 247% gain. Now, some of you are thinking, why would the ratio revert? Why would silver catch up to gold? And the answer is supply and demand. Gold is primarily a monetary asset. Central banks buy it. Investors hoard it. About 90% of all gold ever mined still exists in some form because gold is not consumed. It is recycled. But silver is different. Silver is an industrial metal. Approximately 65% of annual silver production goes into irreversible industrial applications. Solar panels, electronics, medical devices, batteries, water purification. That silver is gone forever. It cannot be economically recycled. And industrial demand is exploding. According to the Silver Institute, the solar industry alone consumed approximately 200 million ounces of silver in 2024. For 2026, demand is projected to reach 287 million ounces, a 43.5% increase. Electric vehicles, AI infrastructure, 5G networks all require massive amounts of silver. And here's the problem. Annual global silver mine production is only 800 million ounces. Of that, 520 million ounces goes directly into industrial consumption. That leaves 280 million ounces available for investment demand, ETF inflows, and vault accumulation. But investment demand plus industrial stockpiling is running at 400 to 450 million ounces annually. That is a structural deficit of 120 to 170 million ounces every single year. This deficit has been running for 5 consecutive years. The cumulative shortfall is approximately 800 million ounces. That is an entire year of global production that has been consumed and not replaced. Supply cannot increase because 70% of silver is a byproduct of mining copper, zinc, and lead. Even if silver doubles in price, it does not automatically trigger new silver mines. And for primary silver mines, the timeline from discovery to production is 8 to 12 years. The shortage is happening now. Supply cannot respond. And as the $45 trillion wealth transfer accelerates, as Gen X and millennials move inherited wealth into hard assets, the demand for physical silver will overwhelm the available supply. Let me show you the evidence that this is already happening. On January 13th, 2026, 5 days ago, the United States Mint suspended all silver product sales for the first time in modern history. They cited unprecedented demand and supply chain constraints. But the U.S. Mint is a government entity with priority purchasing authority. If they cannot source silver to mint coins, what does that tell you about the available supply? It tells you the supply is gone. On January 7th, 2026, JP Morgan stood for delivery of 8.1 million ounces of silver at COMEX, representing 99% of all January deliveries. One bank took almost the entire month's allocation. This is not normal. This is panic buying. This is institutional players who know the shortage is real and are grabbing metal while it still exists. And physical premiums are exploding. In Tokyo, physical silver bars are trading at $130 per ounce. The paper spot price shows $89. That is a $41 premium, a 46% markup over paper prices. In Dubai, premiums are running $25 to $35 over spot. In India, dealers are quoting $110 to $115 for guaranteed delivery. The average global physical premium is approximately $20 to $25 over the paper price. That means the true clearing price of physical silver, the price at which actual metal changes hands for delivery, is not $89. It is $109 to $114. The $89 paper price is a fiction maintained by a derivatives market that does not have the metal to back its promises. And here is where the $45 trillion wealth transfer collides with the silver shortage. Because the people inheriting this wealth, the Gen X and millennials receiving trillions in the coming years, are not boomers. They do not trust traditional financial institutions. They do not believe in the stock market the way their parents did. They watched the 2008 financial crisis. They watched the 2020 COVID money printing. They watched their parents' 401ks get cut in half twice in their lifetimes. And they are choosing different assets. According to UBS Global Wealth Report 2025, women are expected to control approximately $40 trillion of the wealth transfer, either through direct inheritance or through widowhood. And women invest differently than men. They are more risk-averse. They prefer tangible assets. They save more in deposits and hold more physical gold and silver. As wealth shifts to female control, demand for physical precious metals will increase. And according to Jupiter Asset Management, millennials and Gen Z clients at high net worth focused firms grew from just 8% in 2021 to 25% by 2024. That is a threefold increase in 3 years. These younger investors are more willing to invest in alternative assets, including precious metals, private equity, and direct investments. They are not buying bonds yielding 4%. They are buying assets that cannot be debased. And silver, with its low entry price and massive upside potential, is the perfect vehicle for this demographic shift. Now, let me show you the timeline, because the $45 trillion transfer is not spread evenly over 10 years. It accelerates. According to Cerulli, Gen X will receive nearly $1.4 trillion per year over the next decade. That is $116 billion per month. But the transfers are not linear. They spike around major life events, deaths, retirements, estate settlements. And demographic data shows that the peak years for boomer deaths are 2026 through 2030. The oldest boomers, born in 1946, are turning 80 in 2026. Life expectancy is approximately 78 to 80 years. We are entering the peak death and inheritance years right now. And here is what that means for silver. If even 5% of the $1.4 trillion per year flowing to Gen X gets allocated to silver, that is $70 billion of annual demand. At current prices of $89 per ounce, that represents 785 million ounces of annual silver demand just from Gen X inheritance wealth. Annual global mine production is 800 million ounces. Gen X alone, allocating just 5% of inherited wealth to silver, would consume the entire year's production. And that is before adding millennial demand, before adding industrial demand, before adding investor demand from the rest of the world. The math does not work. There is not enough silver to meet the demand that is coming. And this brings me to the most important point of this entire video. The $45 trillion wealth transfer is not a future event. It is happening right now. Today, January 18th, 2026, somewhere in America, a Gen X or millennial just inherited $500,000 from a deceased parent. And they have a choice. Leave it in a savings account earning 5% while inflation runs at 8 to 12%, losing purchasing power every single month. Put it in the stock market at all-time highs, betting that valuations can go higher despite every historical metric screaming bubble. Buy bonds yielding 4%, locking in a guaranteed real loss when adjusted for inflation, or buy hard assets. Real estate, gold, silver. Assets that have held value for thousands of years. Assets that cannot be printed. Assets that appreciate when currencies collapse. And for someone inheriting $500,000, silver offers the best risk-reward ratio of any hard asset. If they buy real estate, they need to put down 20%, deal with mortgages, pay property taxes, maintain the property. If they buy gold at $4,647 per ounce, they get 107 ounces. But if they buy silver at $89 per ounce, they get 5,617 ounces. And when silver hits $200, which every fundamental indicator suggests is conservative, those 5,617 ounces are worth $1.123 million. They turned 500,000 into 1.1 million, a 124% gain, just by holding physical metal through the repricing event that is already underway. But here is the trap. The trap is thinking you have time. The trap is believing that silver at $89 is expensive. The trap is waiting for a pullback to $70 or $75 that will never come. Because the people moving the $45 trillion, the financial advisors managing the wealth transfer, the family offices handling multi-generational estates, they are not waiting. They are buying now. And the evidence is in the vault data. COMEX registered silver inventory stood at 127 million ounces as of January 14, 2026. That is down from over 400 million ounces in 2020. The vaults have drained by 68% in 5 years, and the drainage is accelerating. Between January 1st and January 14, 2026, COMEX lost approximately 11 million ounces, a rate of 785,000 ounces per day. At this rate, the vault will be completely empty by May 2026, and on February 20th, 2026, first notice day for the March contract, if delivery demands exceed available inventory, COMEX will face a choice. Implement emergency measures, raise margins, impose position limits, offer cash settlements, or declare force majeure and admit they cannot deliver. Either outcome destroys confidence in the paper market. And when confidence in paper dies, physical silver resets to its true value, which based on current premiums is already $109 to $114 and could easily go to $150, $200 or higher as buyers scramble for the remaining supply. Now, let me address the counter-argument. Some analysts are saying silver at $89 is overvalued. Citigroup forecasts silver averaging $70 for 2026 and calls anything above that fundamentally overextended. HSBC raised their forecast to $68.25 but warns of downside risk. These are the same banks that predicted $32 average silver for 2025 when the metal delivered a 146% rally from $28 to a peak of $92.25 on January 14th, 2026. They were wrong by a factor of 3. They missed the entire move. And now they are telling you to sell at $89? These banks are short silver. They need you to believe the rally is over. They need you to sell. Because if everyone demands delivery simultaneously, the banks go insolvent. Do not listen to them. Look at the fundamentals. China implemented export restrictions on silver on January 1st, 2026, cutting Western access by 85%. The U.S. Mint suspended sales on January 13th. COMEX vaults are draining at 785,000 ounces per day. Physical premiums are $20 to $40 over spot. Industrial demand is growing at 15 to 20% annually, and the $45 trillion wealth transfer is just beginning. Every one of those fundamentals points to higher prices, not lower. But here's the urgency. Because while silver is cheap relative to where it is going, it is not cheap in absolute terms. At $89 per ounce, many retail investors feel priced out. They remember when silver was $20 or $30 and $89 feels expensive by comparison. But that thinking is backwards. Silver is not expensive because it went from 30 to 89. Silver is cheap because it is going from 89 to 200 or higher. The price you pay today is irrelevant. The only thing that matters is the price you sell at in the future. And if you buy at 89 and sell at 200, you doubled your money. If you wait for 70 and it never comes, you own 0 ounces and you missed the entire move. The $45 trillion wealth transfer does not wait for you to feel comfortable. It does not wait for you to be ready. It is happening now, and the people who position early, who buy physical silver today at 89 or 95 or 100, those are the people who will capture generational wealth. The people who wait, who try to time the bottom, who believe the banks telling them it is overvalued, those people will watch from the sidelines as their inheritance evaporates and wonder why they did not act when they had the chance. Let me show you one more critical data point. According to Coldwell Banker Global Luxury 2026 Trend Report published January 16, 2026, nearly $2.4 trillion in U.S. real estate will change hands in the next 10 years as part of the wealth transfer, representing 52% of all global luxury property transfers. Gen X is the primary recipient of the near-term transfer, while millennials inherit the largest share long-term. Since 2020, global wealth among high-net-worth individuals has grown nearly 40%, including a 29.4% increase in real estate holdings. Real estate is functioning as a stabilizing countercyclical asset. But here is the problem with real estate for the average investor inheriting wealth. Real estate is illiquid. You cannot sell a house in 24 hours. You cannot divide a house into small portions. You cannot store a house easily. But silver is liquid. You can sell an ounce in minutes. You can buy as little or as much as you want. You can store it, transport it, divide it. And most importantly, silver offers far greater upside than real estate over the next 5 years. Real estate has already appreciated 29.4% since 2020. That is a strong gain. But silver has appreciated 150% in 2025 alone, and silver is just getting started. While real estate is stabilizing and likely to grow at 5 to 10% annually, Silver is in the early stages of a supply-demand imbalance that could drive prices up 100 to 200% or more in the next 24 months. If you are inheriting wealth, if you are receiving a portion of that 45 trillion, you should allocate a meaningful percentage to physical silver. Not all of it. Diversify. Own real estate. Own gold. Own land. But do not ignore the asset that offers the best risk-reward ratio for the smallest capital outlay and the greatest upside potential in a world where currencies are being destroyed. And here's the final warning. Because the window to buy physical silver is closing, not metaphorically, literally. The U.S. Mint suspended sales on January 13th. Other mints will follow. Royal Canadian Mint, Perth Mint, Austrian Mint,